Welcome to the What to Watch video update. This is the last video that I prepare over the weekend where I pull out the charts that really seem to be saying something right now and I put them into three categories. Those things that are positive, those things that are negative, and then those things that we're just keeping an eye on to see if they have an impact on the market. And we're still looking more weak. We're seeing this defensive rotation continue. And we had a pretty significant down day on Thursday. It was the old pump and dump where we had a positive open. We went up, we hit the 20 period simple moving average. That was the high for the day. Everything reversed and we went down rather aggressively and ended up being down pretty severe that day. Now, we did bounce on Friday. The indexes went up, the small caps and the mid caps bounced up, but the the shorter term is still looking more negative. We didn't really see much of an improvement. And so we're asking the question this week, will the decline continue? All right, and it's being prepared for Monday, November 24th. Before I get into that, between now and the end of 2025, I have a program called the SPX Investing Program. Everything's free right now. And there's two places. One, the spxinvesting.substack.com. That's where you have access to everything, and you can even set up times to talk to me if you'd like. I've been an educator for a long time. I've been in the markets for close to 40 years. So, yeah, I might be able to help you if you just want to throw some ideas back and forth, and I love to do that. And then there's another site called spxvideos.substack.com. You can sign up there. All you need is an email address for that one. You don't have to provide payment information. Unfortunately, with the big website, it's a Substack thing. Even if it's free, they still want you to submit your probably debit card information. I don't necessarily agree with that, but I can't really control that. So that's why I set up the other website. Now, you don't get access to everything in the program, but you do get immediate access to all the videos. And just reach out to me and let me know if you think more should be published on that other website. So anyway, just check it out. And I'm going to be changing a lot of things when we go into 2026. But between now and the end of the year, see if this is something that would be useful to you. All right, so let's go through and look at the positive things here. And there are still some positive things. Now, you could take this chart as negative as well. What I'm trying to do with the positive side, because we kind of have to look at it this way. The shorter term and even somewhat intermediate term, now I classify short term as days to weeks. I classify intermediate term as weeks to months, and I classify the long term as months to years to even decades. So when we're looking at the long term, which is months to years here, we've been, for the last few years, we've been going up with this ratio. This is an S&P to 3 to 7 year bond ratio. And this is going up ever since we came up out of the April lows. Now, we are giving some back, and we'll be keeping an eye on this. But the reason this is positive is the bigger picture is we haven't really switched yet. We're just looking to have more of a normal pullback. Now, the reason the soft landing and hard landing are on here, when the market's going up this way, which is what it's been doing for the most part, with a few major dips along the way, the market is not anticipating that we're going to go into a recession. And there's pretty much everything that I look at. We might go into a recession, but all the data that I look at says the market doesn't think we're going to go into a recession. Now, you can listen to other videos, you can read blogs, people can post their opinions and all this stuff. I listen to those things, but I look at the charts. What's the market saying? That's what we really need to pay attention to. That's why I look at a lot of different charts. That's why my videos are longer. That's why I do a lot more in-depth analysis because I'm an educator. But at the same time, I'm also in the markets. And I have found over decades of doing this that you get the best edge by soaking in as much information as you can, using that as your background, and then drilling down to what's happening right now. Okay. Now, in the short term, yeah, this is looking a little bit weak here. In the bigger picture, it's not really changing the overall context. That's why I have it positive. And then this is that same thing, only inverted, where bonds are underperforming the S&P 500 or stocks. That's still seeing this trend going down, even though we've been bouncing back up. So at this point, and I said this a week ago, and it still looks this way right now, it just looks like we're having a pullback. It doesn't look like we're shifting over to more of a negative environment. Now, if we keep going down and these things continue, like this one keeps going up and this previous one keeps going down, yeah, we might have to adjust that. But looking at this chart and lots, hundreds of other charts, we're just seeing the big picture still staying positive, even though the short and even somewhat intermediate term has switched over to looking more negative. Okay, now, as of Thursday and Friday, the 100 period moving averages are holding right now. That's why this is positive, because we're still above this. Now, later on, I'll show you a chart with a bunch of different moving averages on here, but I wanted to just break this one out and treat it as positive. And for right now, this is more, it's somewhat intermediate to a little bit long term. I use the 20, 50, and 200-day moving averages. About 10, 12 years ago, when we were just kind of meandering up, it's like, oh my gosh, we've got this big space in between the 50-day moving average and the 200. Well, I started incorporating the 100-day moving averages into that and found, hey, that's kind of useful for these kind of in-between times. And I've just kept using it ever since. So for right now, this is holding and that is positive. Now we look at a long-term rainbow. Now look at the short and intermediate term rainbow. We're seeing a little bit more weakness, but we've come down into the rainbow. That's negative. But you see where we haven't been here for very long. And the lines are still continuing to go up. Now we keep coming down. We stay around this area for a while, then yeah, these lines are going to begin to roll over. And on this long-term rainbow, this starts at a 50 period moving average and goes all the way up to a 250 period moving average, where the 200 is what I really focus on for the long term. So I was kind of a little bit right of center here. But this is still holding up for right now. If we see more continuation to the downside, this chart might start to show some damage. All right, and then those stocks inside the S&P, there's 503 stocks last time I checked that are in the S&P 500. So yeah, a little bit more than 500 there. And those stocks that are above their 200-day simple moving average is still above 50. 50 is the dividing line between positive and negative. Now we start looking at other studies and we're below 50, but this one, longer term, we're holding up. And we did bounce up a bit in Friday's session. We're still holding at support. This is the Ichimoku cloud. I sometimes call it the itchy and scratchy cloud. Haven't shown this one for a long time. Now you look at these lines here, and this green one's kind of hard to see because it's short term and it kind of intermingles with the bar chart and these other lines. It's coming down even though it bounced up with Friday's bounce that we saw. That's short term. Then the blue line, that's intermediate term, and it's going down and it crossed below the red line, which is long term. So yeah, we're taking a bit of a hit here. The reason why this is positive is we've come into this cloud, and quite often what we'll see is when we come back down here, this cloud may end up providing support. And so far it has. We haven't fallen below it. We fall below this, it's going to switch this chart more over to negative. But for right now, it is still looking positive. And then in Friday's session, we had a bounce, even though we didn't show a lot of internal improvement with the S&P. This chart had been going down and it turned up after Friday. This is the Swinland Trading Oscillator, and this is broken out based on price and volume where we're turning up on both. And so that is taken as positive here. In longer term, we have a daily chart of a thing called a special K. I only show it in this chart, and then I do a deep dive video where I show it because we don't get very many signals with this chart, so why show it all the time? Well, I still show it here, and I had to find something that was positive right now. Now we are rolling over, and we crossed back above this in early August to go from negative over to positive, but we don't get very many signals here. So there is a little bit of weakness, but we're still above the red line. So this is positive. Then here's a weekly chart, and this is even longer. My goodness, we went years and years without actually crossing above. We got pretty close. Even during the whole COVID crash, we only made it down to the red line and then bounced up off of that. So the fact that this is above the red line, that is positive. And even when we came down in April, we just got back down to the red line. So bigger picture, looking positive according to this chart. Now, I've been pointing this out too, where the S&P, which is represented here by the ETF, the SPY, and the staples ratio. Staples are toilet paper and toothpaste, things that people have to have no matter what's going on in the economy. And when the market's getting ready to go down or to have some problems, it starts to favor staples over discretionary. Those are the things that make life fun. Well, a big part of discretionary is Amazon and Tesla, and those stocks have been under pressure lately. Now, we look at this in the bigger picture context, though. Right at the end of 2021, we were going up, everything was fine, the market's never going to come down ever again, everybody's happy. Well, then, even before we hit the all-time high, right, in early 2022, this ratio started to roll over. This rolled over and started to go down before we started to really go down with some conviction based on price. And then we were going all crazy here last spring because nobody really knew what to expect with the tariffs and all that stuff. Well, we came up out of that and we've been looking positive for the most part. Now, in the short term, yeah, we're coming back down into the rainbow, but we're not seeing a real characteristic shift. This one is just crazy. The tariff tantrum that we had, what I'm trying to compare it to is what happened in late 2021. Are we seeing a similar thing? Yeah, we're coming into the rainbow, but we're not seeing the lines begin to roll over. Now, any more weakness? Yeah, we're going to get more concerned. And if these lines start to roll over and go down, yeah, we'll get more concerned. But all we can go with right now is what we're seeing here. I don't forecast, I don't speculate, I just analyze and then react to what I'm seeing in the charts here. So this is still holding up for right now. So I'm treating that as positive. Now, another thing that could end up being quite positive, it's a thing called the Zwag NYC Breadth Thrust. This was developed decades ago by Marty Zwag, one of the very first books I ever read in the early 90s when I was getting into the stock market. And he's since passed away, and now his son has kind of taken up after him. Well, he came up with this thing that was actually named after him, the Zwag NYC Breadth Thrust. And we had one of those, at least the initial part of this. Now, we don't know if this is going to lead to anything. We just have to watch this unfold. Unfortunately, with this chart, there's 1 day lag here. And this is as of Thursday, the 20th. And this is when we had the pretty significant down day. And we had a reading down below this blue line, which is at point 0.4. Now, what we need to see happen is once we finally stop going down, and maybe we're stopped going down now, but we don't know. If there's more weakness, this could go down even more. But based on what we're seeing right now, on November 20th, that's the first signal. Now, within 10 trading days or looking out to December 5th, we have to come all the way back up to this red line. That means we're going from extreme positive, excuse me, extreme negative to extreme positive in a short period of time. And that's boom, that's called a breadth thrust. Now, we did have one coming out of the April lows. And then after that was finally confirmed, look at how the S&P went up after that. And we've had some others. Here's one in 2023, did well with the S&P. Here's one in late 2023. Look at what the S&P did after that. Now, sometimes we get the initial signal here, but then it doesn't follow through by going to the upside. And so this is like a two-part signal, and we're only seeing part one right now. So we'll keep an eye on this. I'm monitoring this. I'm going over it in the daily videos, and we'll see if we're able to get up here by December 5th. All right, and then with our longer term ratios, the Nasdaq 100 to Dow, the Nasdaq 100 is considered growth. The Dow is considered the best of the value, even though there's some growth stocks in there. And we're coming down a little bit with this ratio, but we're still well above this red line. This red line is where we topped out during the dot-com boom, and then after that was the dot-com bust. And then we came up here right to this line, and then we came back down. This is when we went into 2022. Well, we've actually broken above this red line now, and we've been above it. And even though we're giving some back in the short term, this is still looking positive in the longer term. A similar thing here. The QQQs, Nasdaq 100 to IWM, that's the Russell 2000 small cap ETF. Still above this blue line, still going up for the most part. That's positive. If we were getting ready to shift, we would see something more like what we saw back in 2000. And this ratio would just be tanking like crazy. That's not doing that right now. And then semiconductors, which is growth to Dow, coming down here. Semiconductors, I've been watching them really closely, and I'll have some other charts later on to show you. And that was when we came up out of the lows in 2022, it was the semiconductors that really started to get going first. And so I'm really watching the semiconductors now because they are showing some weakness. And if they start to continue to show weakness, then we might have to modify our current stance that we're still maintaining a positive backdrop in the bigger picture. Now, we are coming down here, but when we do this ratio, we're still above this blue line. And again, we topped out here back in the year 2000 before things just went crazy. We're still above that level now. All right. And then from a seasonal perspective, we should be going up. But somebody forgot to tell 2025 that. And November's been a very difficult month this year. This also points to positive seasonality going into the end of the year. Maybe it'll happen this week. This is the week right when we have Thanksgiving. And then we go into December. Maybe folks will have a little bit of Christmas cheer and end up doing a lot of buying. So we do have positive seasonality, but there's seasonality and then there's reality. And the two are kind of in opposite directions right now. And then this also shows seasonality, where the first half of November performs really well, not this year. And then the second half of November tends to perform well also, and we're still waiting to see how that's going to play out. Now the negative side, and unfortunately the list is longer here, and but a lot of this is shorter term. Keep in mind that for right now, in the bigger picture, we're still looking okay. But we have fallen down below the 50-day moving average. We dropped below this dashed line here, which is a pivot point. So we've broken some support here, and it's harder to see. I'll try to point this out in other charts, but the chart itself is not really looking all that good right now. Okay, and then from a sentiment perspective, now this is negative because we're getting such a low reading, but we actually saw almost a 50% increase in Friday's reading. We were down at like 6, and I think we're at 11 right now. Well, we start to be extreme when we get down to the 25 level, and then if we even drop below that. But the context here is that this is still going down. Now, that's the negative part. People are really pessimistic about the market. At the same time, that can end up being positive because a lot of times when we see the market really, really shift, like at the end of 2021, everybody thought the market was going to go up. All these projections for 2022 were just sky high, new all-time highs. All the charts were looking okay, except for under the surface. We started to see a real breakdown at the end of 2021. Now, and I don't have it way back here, but sentiment was really positive at that time. Well, now we're already pessimistic about things. And usually it's when the market is in la la land, just thinking it's just going to magically go up, which is kind of where we were earlier on throughout the summer. It's like the market's just never going to go down. Well, now there's some doubt being thrown onto that. It just seemed like no matter what happened, we would go down to the 20-day moving average and bounce up off of that. Now we're being tested a little more deeply at this time. And so what I'm getting at here is it's negative in its context, but it could be positive in that when we have sentiment as low and as fearful as it is right now, that rarely leads to a crash, a real change in the overall climate of the market. So, but now we could bounce back up for a while and then come back down again. But again, we can only go with what we're seeing right now. Now, bigger picture, this is still looking okay with the intraday chart here with large cap growth in blue, large cap value in red. But you can see, coming here, we're coming down with both of these lines. They're both getting hit right now. So the shorter term context is that this is negative. We're also seeing this with the intraday growth to value chart for the S&P. These are 10-minute charts here. This is negative. And even with Friday's bounce, it still didn't really improve it all that much. We're still below the moving averages here. And we want this chart to be going up like we were seeing back in October. And then we kind of topped out. And the context here for most of November is that we've been going down. We have a few days along the way here where things look better, but it's not looking as healthy as you would like it to be. And then here, now the small cap growth to value ratio, these are end of day charts, falling down below its 50-day moving average. Now, small caps did have a good day on Friday, but this ratio still went down. But small caps have been a real disappointment. Now, we're coming into a time of year, the Santa Claus rally, where quite often small caps might see some favor. We'll see if that actually ends up playing out. We saw that in 2023. We saw it in 2024. And yeah, the Santa Claus, he showed up, but he forgot to bring any gifts. And we just kind of fizzled out as we worked our way into the next year. We'll see if something like that ends up happening. But this is positive in the bigger picture, but we've really been pulling back with this ratio lately. And we're even falling apart even more with the mid caps. Not doing good with the mid caps right now. Ratio below the 50 and 200-day moving average. Now, in the bigger picture, we are in an uptrend, and this had been holding up fairly well. We had a little bit of a dip here in August, but we got back above this. Now we're seeing more of a real shift overall, and that's negative. And we're seeing that same thing here with the growth to valuation for the S&P, still in a longer term uptrend, but we could not get back above the 50. And this started back in August. We've been watching this, and we just kind of dangled here and drifted lower, and now we're seeing a little bit more aggression to the downside. We need this ratio to start going up to be more positive on the market. Even if we don't see it in the index, we want this ratio to show an improvement, and it's not improving right now. And then this growth to value ratio, this was holding up a little bit better, but this is similar to some of the other charts. Bigger picture, we're looking okay, but now we're falling back into the rainbow. They have a number of different growth to value ratios. The Qs to S&P declining below a declining moving average. And the discretionary to the S&P, we did turn up on Friday, but we're still below a declining moving average. And then we compare large cap growth to large cap value, declining below a moving average. Not positive. And then so the large caps, mid caps, and small caps, they're all declining currently. Then we look at discretionary to staples. We're not falling below the 200-day moving average at least yet, but it was doing a lot better, but it's really kind of fizzled out here with this overall ratio, and that's negative. And then large cap growth, the reason this is negative, we're holding out above the 100-day moving average. That's the positive part, but we're down below the 50-day moving average here. This had been holding up fairly well, and well, we lost that. And we're now trying to decide, or the market's trying to decide, are we going to be able to get the 50-day moving average back? Bigger picture, though, look at how these lines are still going up, and we spent a lot of time above these lines. So bigger picture positive, shorter term negative. And then high beta to low beta, bigger picture positive, shorter term negative. Value to tech, bigger picture negative. We want value to underperform tech. We want tech to be doing well. And that's what's been happening. And that when tech outperforms, this ratio goes down. But we've been bouncing back up into the rainbow. So that's more negative in the short term. And then risk on to risk off, bigger picture positive, shorter term negative. The VIX above 20. And that's when we see negative annualized returns that I'll show here in just a moment. But this is not really good right now. We're seeing a real pickup in fear with the VIX. This is research put out by Tom Bally, who is connected to stockcharts.com. He's also connected to earningsbeats.com. I have no relationship with him. I just ran across this research that he did, and I just want to give him credit for doing it. But when we go above 20 with the VIX, that's when we see negative annualized returns. When we're down below 20, that's when we start to see positive annualized returns. And the further below 20 we go, the better the returns are. They are. Well, we're above 20 now. We closed at 23.43, which we were at 26 after Thursday. So it was an improvement, but we're still above 20. So this is negative. And then we improved on Friday a little bit with the advanced decline line, but shorter term, we've been declining based on price and volume. But the bigger picture is we're still above these advancing moving averages. And we're below zero with the advanced decline oscillator. We ticked up a little bit here, but for the most part, we've been spending the last number of days below zero. And we saw a little bit of an advance here with the new highs. It's like, okay, these are value stocks that are making new highs. We did see a bit of a contraction of the new lows on Friday, but overall, we've been seeing the new highs coming down and a bit of an increase here lately with the new lows. Now we're trying to turn back up with the 5-day chart, but we're not above the moving average. We were declining and we're leveling out here with the 10-day moving average. We need to see both of these lines turn and go up. We need to see a lot more green than red for this to show more internal improvement inside the S&P. And we're negative. I have three smart money indicators. We're negative with all three. Accumulation distribution below the moving average, that's longer term. Now we did bounce up. This is shorter term. This is a modified MACD. We came up, but we're not quite back above the moving average. That's the negative part. Now, we could be extreme when we get below this green line. Now, this is all crazy. This is back in March and April when the market was starting to freak out. This is more orderly here. When we get down below this green line, that may mean that we're getting extreme negative and we might be due for a bounce. But if we go above the moving average here and we're still below the moving average up here, that's not really positive. We want both of these to be above their moving averages and advancing. And then Chaikin money flow, it bounced up a little bit on Friday, but there's a red line here that's continuing to go down. This is smart money indicator number two that's negative, and we're still declining with the Chaikin oscillator. That's smart money number three indicator that is negative as well. We're negative with the vortex. The red line's going up, the green line's kind of flat, and that's negative overall. Now we look at the trend. First, we look at the short-term trend. Now we are rolling over a little bit, but we're just barely above the moving average here. We never did get above 20. So that means that we are showing a strengthening trend since we're still technically above the moving average, but it's not a confirmed trend because we haven't crossed back above 20. I use 20 as a static level. Other people might use 25. I've read books on the ADX and people use different levels. I have found over the years that 20 seems to work well with the S&P 500. Now we're negative here because even though the red line's coming down, the green line actually declined a little bit. What was really strange in Thursday's action, it picked up the move up here, and the red line actually came down, and the green line actually went up on Thursday, even though we ended up having a significant down day. And while I'm pointing this out, maybe this is a little bit clearer here, where we set the all-time high back in October, and now we came down, we tried to bounce back up, but what we've been seeing overall here is a series of lower highs and lower lows, and that's not a very healthy chart pattern. Now we're coming back down to these previous levels here. There's also this gap down here that we had where we really started to move up. We gapped down. That was back in right at the beginning of August when that happened. Maybe we'll come back into one of these areas here, but the chart pattern itself is not looking all that healthy. Also, in the short term, we are negative with the trend. We're negative with the intermediate term with the trend. The red line's still above the green line. We're rolling over with the ADX, but we're still above the moving average. Now, the big one is the next one. This is a weekly chart, much longer term. We saw the red line cross above the green line. This has hung on to being positive for quite a while now. Now, we were never in a confirmed trend. We were starting to strengthen as we were going up here with these weekly bars, but we didn't quite get there. And now we're starting to see a weakening trend, but it's instead of defaulting to positive when the green line's above the red line, now we're defaulting to negative. And also, you can see the chart pattern here, higher highs, higher lows. That is being tested right now. We're seeing lower highs and lower lows over the last 4 weeks or so. So this is looking a little bit more vulnerable longer term with your basic chart pattern here. All right, and then the short-term moving averages, we are negative here. We're below the rainbow. And this starts at 10 periods. I focus on the 20 in the short term, 50 period in the intermediate term. The longer we stay down here, you can see the lines are starting to roll over just a little bit. And this is going to turn more negative for the short term the longer we stay below the rainbow. And then here's an intermediate term. Now, these lines are still kind of okay for right now because we haven't been inside the intermediate term rainbow from 50 periods up to 100 periods. We haven't been here very long. Now, if we can bounce out of this and make this a really short stay, these lines will still maintain their overall integrity. If we continue to go down and we stay below the rainbow or we stay inside the rainbow, then the lines are going to start to roll over. And then here are the moving averages. And I have it on the negative side because we're below the 20s and we're below the 50s. Now you notice here on Thursday's action when we had the, NVIDIA comes out with this great earnings report. It's up over 5% in overnight trading. The futures for the S&P are up 1 to 1.5%. Everybody's just tripping over each other to jump in right at the open to buy NVIDIA stock. And one of the scenarios I was just throwing out there is beware the pump and dump. We've seen this when NVIDIA has reported their earnings before. And then it played out exactly that way on Thursday. It's just one of the scenarios that we were keeping in mind. Well, notice how we came right up to the blue line. That's the 20-period simple moving average. And that was the high for Friday. It was also the high from the previous Friday if you look at the intraday chart. And that's where we topped out, and then we just came down ferociously all the way to the 100-day moving average. Now, we're still above the 100. That's why it's on the positive side. but we're below the 20 and the 50. That's why this chart together is on the negative side. And we're still far away from the 20 period moving average. The boom indicator, it measures how far above or below we are from the 20, 50, and 200-day moving averages. Well, we're getting kind of far away from the 20. Now we're below the midpoint. We're below zero with the 50-day moving average, but we don't call this extreme until we get down to the red line. We are declining, but we're still above zero here with the 200-day moving average steady. But the reason this is negative is because we're below the 20 period moving average, and we're still seeing weakness with the 50 period moving average. And then the S&P McClellan oscillator, it bounced up on Friday, but it's still below zero. And so when that's below zero, we're still declining with the summation index based on price and volume. That's negative. Broader market, the NYSE McClellan oscillator bounced up on Friday, but still below zero. So we continue to decline with the the NYSE summation index based on price and volume as well. Negative there. Momentum, PMO, still negative here. We break it out based on price and volume, also declining. And then there's a bunch of studies because these are PMOs of all the stocks in the S&P. Now this did improve, and this is kind of encouraging, but we went back above 50 with the PMOs that are rising, but it's a lot of the value stocks. We're not seeing a lot of strength and growth right now. We're seeing more value that's rising, which tends to be more defensive, but this is, hey, we'll take it. We're back above 50 here. We did turn up, but we're still below 50 with the buy signals. And after declining, we're leveling out here with the PMOs that are above zero. This is another negative sign here. Parabolic SAR daily chart. We never did turn to positive. We drifted down here. We had that big down day in November. We tried to come up. We didn't quite set a new all-time high, but the parabolic SAR never turned positive. When it's on, the dots are on top, that means this is negative. And so we've been declining, and this is continuing to be negative. Now, the next one is the big one. Weekly chart. Had been positive for a long, long time, many, many weeks. This past week, we finally are seeing a dot on top. So this is a longer term chart that's actually switching over and looking more negative. And we look at our different momentum oscillators here. Two short term, negative. Three intermediate term, negative. Two long term, negative. And then the copy curve, another momentum oscillator, is also negative. And then bullish percent index. This measures the point and figure buy or sell signals inside the S&P. And we're dropping here. We're below 50, so that means there's more sell signals inside the S&P that are being triggered than buy signals, and we're below the moving average. Now we closed up off of the low, that's kind of good, but we still ended up being down for the day, and we have been declining. This is a primary indicator that it's now negative. We're also declining below 50 with the NYSE bullish percent index. We came right down to the 30 level. That's when we start to get extreme negative. I mean, look at how crazy this was back in April. Just down, 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 down. Well, looks a little bit more orderly, at least to this point now, with the Nasdaq 100 bullish percent index. But we're negative since we are below 50, and we did decline in Friday's session. And then we did improve with those stocks in the S&P above their 20-day moving averages, but we're still below 50, so that's negative. We improved, but still below 50 with the 50-period moving average study and with the 100-period moving average study. Notice, remember, back to the positive side, we're still above 50 with the 200-day moving average study, but the 20, 50, and 100s are still negative even though they improved on Friday. And then we look at the advanced decline lines, which all improved on Friday, but they're still below these moving averages here, so they're negative overall. And then when this ratio is going down the way it has been, that means the S&P 500, which is a weighted index, that means Nvidia, Google, Apple, Microsoft, when they're really strong, that's when the S&P 500 is strong. When this ratio is coming down, that means the equal weight is actually outperforming. And that means the big stocks aren't really providing much leadership. Now, the bigger picture is we've been going up, but we're also pulling back here more in the short term. And then this is another way of looking at that same ratio, but I've just flip-flopped it here. This is the equal weight compared to the S&P. Bigger picture, we've been declining, meaning the equal weight has been underperforming, but lately this has been bouncing back up. And then the Dow, underneath its 50-day moving average, just what, week before last, it set an all-time high above 48,000. Now it's down below its 50-day moving average. But in the bigger picture, it's still in an uptrend. Nasdaq, still in an uptrend, seeing some weakness here below its 50-day moving average. Nasdaq 100, uptrend, bigger picture, seeing some weakness here. And then the momentum for the Nasdaq 100, it rolled over. It was turning positive at the end of October, and it's just been negative here pretty much for all of November so far. And then we're dropping below this midpoint. Now, you could say this is still positive. This is a very long-term chart going back to 2009, but we have spent a considerable amount of time above this trend line. Now we're starting to drop below it. So I'm treating that as more negative. Small caps. Now they had a good day. The S&P 600 was up over 3%, but it's like we've been here before. We're just kind of coming down and maybe bouncing back up. We're still in an uptrend here, but we're below the 50-day moving average. Then another, probably more popular small cap index is the Russell 2000. This also was up 2.83%, also still below its 50-day moving average though. Mid cap's not doing well, actually coming down and dealing with its 200-day moving average, but it also bounced up on Friday. The Wilshire 5000, the reason this is negative, bigger picture positive, shorter term, we're below the 50-day moving average. Same thing here with the total US stock ETF below the 50-day moving average. The FANG index, Facebook, Apple, Amazon, Netflix, Google, below the 50-day moving average. And we're seeing these ratios going up. Bigger picture, we've been declining with the staples to tech ratio. Shorter term, this ratio is going up. That's the market getting more defensive. And it even went up in Friday's session. And then home construction, it bounced up. It likes that there might be a rate cut in December after one of the Fed people came out and said, hey, I might be willing to cut rates. That's only one person, but the market had to grab onto something positive because there's been a lot of hawkish commentary coming out of the Fed lately. But this ratio from home construction to 3 to 7 year bonds, it's really been down. It bounced, but it's not even back up to the rainbow yet. And here's another one, staples to the S&P 500. Bigger picture going down, that's positive. Lately, it's been coming back up, and it also advanced in Friday's session. And this is a weekly chart of the S&P. Negative because we're starting to see this weekly pattern maybe be threatened. And we were down on the week. Now, the positive side is we're still holding above this R1 pivot point. We'll be watching that, but we still have about 150 points to go just to get to that particular level. And then the semiconductors, positive in the bigger picture, below their 50-day moving average with the Dow Jones Semiconductor Index. SMH Semiconductor ETF, positive in the longer term, below its 50-day moving average. You used a couple of different things there. And then the semi to tech ratio going up overall. That's when the market's really doing well. When the semis are outperforming tech, even if tech's doing well, we like it when the semis are doing even better. But lately, this ratio has been falling back. Momentum stocks on a ratio with the S&P. These actually held up pretty well. This I was watching this chart back then, and this was telling me, I don't know, everything got hit here in March, but we actually made a higher low here. And it's like, okay, I think the market's going to find support. We hit a Fibonacci level, we hit some longer term support and just bounced up off of that. And then we just screamed up out of those lows back in April. Well, not doing that right now. We're actually declining here with the momentum stocks. They're really showing some weakness on a ratio basis. That's negative. And then, I'm not a big, I don't talk about Bitcoin all that much. I have my reasons, but let's just keep it at that for right now. But what I've seen over the years is that there's a pretty strong correlation between Bitcoin here in red, which has just been getting hammered. Just what was it? Back in October, we were setting all-time highs above 126,000 or whatever that was. I mean, to the moon, everybody, and then a lot of people got in right here, and now they're faced with what's happening here. I'm not trying to make fun of those folks. It's just you get a lot of people in the markets. They don't know what they're doing. They're going off hype. They're using emotion. Their friends are involved. They're doing a lot of this probably from a smartphone. They're not really analyzing what's going on in the market, and it's gotten handed back to them. And it's sad. I saw that during the dot-com boom and ultimate bust back in the year 2000 into 2001. And then we saw it with the great financial crisis, 2000, late 2007 into 2008. I wish those things didn't happen, but they do because the markets become bloated. Well, there's the correlation here is measured down on the bottom. And when this is getting a real high reading like it is now, that means the Nasdaq 100, which is the bar chart, and red is Bitcoin, just a closing price here. That means that they're going in the same direction at the same time. Well, in this case, they're both going down. And so I've been kind of honing in on this. There's a lot of negative news coming out about cryptos and Bitcoin in particular. And should they have been ETFs? Should they let market makers involved? Is that giving up the independence that it's supposed to have? That was initially touted as a positive thing, but then when the institutions come in and start, okay, fine. But the takeaway from this chart is the Nasdaq 100 is under pressure and Bitcoin is under pressure, and the correlation between the two is currently quite high. Then the areas that we're just keeping an eye on now, we're starting to get jobless claims again here. Not really a problem at this point, but the data's coming out on strange days and it's delayed and all this stuff here. But this isn't really a problem at this time. The continuing claims, that's a little bit more of a concern. It's like the companies are coming out and they're not as fast to let people go, but the people that do lose their job, they're staying unemployed for longer. And there's another chart that I go over in the weekly video, which this is more short-term continuing unemployed. And then when you hit that 6 month mark and you start to go into the seventh month, that's long-term unemployed. And we're seeing a pickup in that chart as well. So this is a bit of a concern. Now it is going up, but we're still below 2 million. That's kind of the line here. And you're going to hear everybody freak out like crazy if we go above this 2 million mark on this chart. So we just kind of are a little bit above the range that we've been in for a while. We were in a lower range for most of earlier 2025. Then we worked our way up to a higher range. We started to drift back down. Now we're starting to go back up. But it's like, okay, this information, it's delayed. It's coming out on different days. There's some economic reports that we're probably not even going to receive. It's like, why? Okay. Anyway, we just want to keep an eye on this. And this puts it together here. The red, these are the initial claims, not really a problem. A little bit concerned about the continuing claims. And then we also, on a strange day, got the employment report. And the next one's going to be on a strange day too, where the unemployment rate actually ticked up to 4.4%. Even though the report itself was good, the unemployment rate did go up. Figure that one out. More jobs than they expected, but the unemployment. I have not trusted the unemployment rate for decades now, way back in the mid to late 90s, I think. They actually started calculating it in a different way. And I know this data is manipulated, and I know it's not necessarily truthful, but it's what the market uses. And so this is why we look at it, realizing that we're probably not really getting the full story of things. But if the market sees this and it reacts in either a positive or negative way, then that's okay. We follow it, realizing that we're probably not getting the full story. All right. And then the dollar. Now we're above 100 here, and strength in the dollar could put more pressure on stocks. Now you look at here on the daily chart, we're still in a downtrend. Right after this is the weekly chart, and we're in an uptrend here because the moving averages were closer to each other. So we're starting to see a golden cross in the longer term weekly chart before we are on the daily chart. But if we see more follow through strength, especially above 100, the stock market likes weaker dollar because of the exchange rate, because of the import export relationships. And the dollar going down really helps stocks come out of that really difficult time that we saw last spring. And then we kept going up as the dollar kept going down. Now it's been showing a little bit more strength. Now, the dollar can go up for a while and not really have much of an impact. But now that we're getting back up to this 100 level, we'll see if that starts to become more of an impact. And then we want to keep an eye on the 10-year yield. It actually dropped on Friday, but interest rates lately is we were below 4%, and then the Fed came out and cut rates, and now we've jumped back up. Go figure. The Fed cut rates and we're going up now. But we've kind of settled into a range, and the bond, 10-year bond anyway, that's what I watch the most, isn't as much of a problem right now, but that could change at any time. And then we want to keep an eye on the spread between risky and not as risky bonds. We are coming down here. That means a little bit more fear is coming in. I have this inverted. It's lined up with the S&P and with the VIX, which is also inverted. So 2 out of 3 charts here are inverted. Maybe I should have just inverted the S&P. But anyway, this coming down could be more negative. See how it really dropped down when we were going down in April, and then as we were going back up, this ratio was going up. We're not really showing a lot of panic right now, but we just want to keep an eye on this chart. And then we want to keep an eye on retail. The middle area, we're dealing with the 200-day moving average with retail itself. Now, we were starting to improve when we look at the retail to S&P ratio. Now it's starting to go back down, even though it came up a bit on Friday. And then another thing, now the top chart, that this is the weighted discretionary to staples. The reason why I bring that out is Tesla and Amazon are discretionary and they're massive stocks. And so they have a huge impact on the discretionary sector. So right down below, we have an equal weight version of discretionary to staples. And these are kind of moving back up here, but the bigger context is that we've been declining here. And that's negative for the market. We're still going down with tech to utilities. Now, biotech to healthcare. Healthcare has just been really strong lately. It still has a ways to go to start to outperform the S&P, and it is a defensive sector, but it's really November. It's been the strongest sector in November. But so we're kind of flat here with biotech to healthcare. Where hotels, my gosh, it's like everybody, let's go stay in a hotel this weekend. They really shot up here with this ratio in Friday's session. But we just keep an eye on this as we do what are called the bellwethers. We're really watching the semiconductors. The home builders actually bounced up a bit on Friday, but they've been declining. The transport's been declining. At retail was declining, bounced up on Friday. Regional banks seeing a little bit of an improvement here. These are the smaller banks, and we want to keep an eye on those in case problems start to develop. And then here with oil, we're actually going down. We're dropping into the high 57 range. And then here are the daily pivot points for Monday. I post these on the website that I have. I also put them on the YouTube community tab. I can't do anything on Rumble. There's nowhere to post this, but these are very accurate. And I found over the years the 10-minute pivot points, because if you do 30-minute charts or 60-minute charts, the pivot points are different. I found that a lot of the algorithms that trade that are not people, they're computers that are trading, they use these very heavily. And notice how in Friday's session, you can't quite see it, but that's where we topped out in the previous Friday. This was the 20-period simple moving average. So I'm not only watching an intraday chart, I'm watching the daily charts at the same time. And we hit this area and then boom, we just took off to the downside, something fierce. We'll see if something like that continues in the upcoming week. And then we have this crazy thing called the Hindenburg Omen, which I ignored for years because I found out about it from a perma bear who's wrong 70% of the time anyway. Well, then stockcharts.com, they put the criteria behind the Hindenburg Omen into this indicator. We had the initial spike back in October, and then we've had some confirmation spikes. And so we have to pay attention to this. And this is kind of playing out right now. We'll see if it turns into anything more. We have a couple of historical context pieces here. We saw this right before the COVID crash. And we saw it right at the end of 2021 before we went into 2022. Now, we had some other spikes along the way that were not confirmed. The perma bears were treating it like it was a done deal, but no matter what you throw positive their way, we're always a 50% crash is always just around the corner. Well, now we're seeing some confirmation here. Now we're getting a reading of 1 after Thursday. There's also a 1-day lag with this one as well. This is after Thursday's big downward move. But the initial spike and then the confirmation spikes, okay, we're just keeping an eye on this and we'll see if this continues to play out. Doesn't mean this is going to lead to anything bad, but it doesn't mean it's not going to either. Things were looking pretty good there in early 2020 and then COVID happened. Things were looking really good right at the end of 2021, then they went bad. Are we starting to see a shift here? We don't know that. We're just asking that question that we can't answer at this point. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.